Okay, let's start the class. Good morning once again. Today we're going to be looking at hydrocarbon tax and how it affects the initial company, the initial Petroleum Profit Tax Act that you guys are familiar with. I want to welcome everyone once again. Someone joined us over the week. I greet that person. If the person is in class, you're welcome. I know that hydrocarbon tax has been one of the topics the examiner usually tests, and examiner expects you guys to also uh, know the hydrocarbon tax as part of the syllabus. And if you look at the trend of the exam in the recent time, you would notice that the examiner had always tested hydrocarbon tax as question number 2. And I don't see any deviation from that in this coming exam. So examiner is still going to do as usual and test you appropriately or accordingly. Okay. So we'll look at it now. Good day to you once again. Okay, just like I said the other time, it is a pattern of the examiner to always test questions from hydrocarbon tax every diet, and we are also expecting they are expected to also get yourself familiarized with this. The main aspect that concerns us is the fiscal aspect. Although I'm just going to do an overview of petroleum industry and what you guys need to know. But the major aspect that is of our concern is a fiscal aspect where we're going to be talking about the computation of tax liability and every other thing that needs to be discussed. Okay, so in our last class, we looked at companies' income tax, where we talked about administration of company income tax and when the companies are expected to pay tax, the various bonuses that they have. If the company is a small business, if it is a large business, we spoke about that. We have said that if a company is a small business, there is no benefits that the taxpayer will get. Why? Because the taxpayer is not even paying tax because it's a small business. And a small business is a business that has a turnover of 0 to 25 million. That's a small business, and the small business is not expected to pay tax. And therefore, they are not going to be benefiting from this bonus that we're talking about. Now, for a medium-sized company, we have said a medium-sized company is a company that its turnover is more than 25 million, but less than 100 million. Now, this bracket, the company is expected to pay a tax rate of 20%. And the Act also provides that if the company pays the tax liability as a when due, that is paid within 3 months or 90 days after the accounting year end, such a taxpayer would get what we call a tax rebate of 2% of the tax due, which will be made available for deduction in the subsequent year when they are supposed to pay tax. The same thing goes for a large company. We had said before now that a large company is a company that has a turnover of greater than 100 million. 100 million and above rather. Now, because it's a large company, the tax rate of a large company is 30%. And the rebate that the taxpayer will get if the tax liability is paid on time is 1%. Is 1% of the tax due, which will also be made available in the subsequent year against the future tax payment of the taxpayer. So these are the few things that we discussed in our last class. We also talked about interest deductibility rule. We talked about Schedule 7. What does that mean? Where we said a taxpayer, when it comes to the interest to be deducted, the interest deducted in a particular year shall not be more than 30% of any before interest, tax, depreciation, and amortization. I will now said, peradventure, this is more than 30%. The balance of the interest not allowed to be deducted as a result of the position of the tax law, the taxpayer can carry forward for a period of 5 years. We spoke about that in our last class. We spoke about business reorganization and restructuring, where we said for better reorganization, a company is transferred to another company. And in that regard, that company must be connected at least 365 days before the transfer took place. And at the same time, we also said that the company in this regard must inform the FIRS about the transition from one company to the other. Now, having said this, we now said, okay, they will benefit from the tax law. Now, one of the benefits or concession they will get, we said they will get what we call, they will not pay tax liability on the asset. Sorry, they will not pay value-added tax on the asset disposed. Capital gains tax will not arise. Asset will be taken over at tax down value. And we also said in our last class that commencement rule and cessation rule will not be applicable to them. So we also talked about business reconstruction. Talk about business reconstruction, where we talked about a reconstructed company rather. What we said, the reconstructed company is a company that was being formally run by a foreign entity and eventually transferred to a Nigerian entity. Now, we said there are conditions to, number one, the company that has been handed over to must carry on the same business of the foreign entity in Nigeria. That's number one. Number two, we also said this company must inform the Federal Inland Revenue Service. Having satisfied these conditions, we now said, okay, to them also, commencement rule and station will not be applicable. Asset will be taken over at tax in value. We spoke about that in that situation, losses of a reconstituted company can be carried forward to the new business. And in that regard, we said the losses can only be carried forward for a maximum period of 4 years, and so on and so on. We have discussed a whole lot of things, and I would expect you as my student to go back to everything that we have talked about. We spoke about, before we move to company income tax, I remember we discussed capital allowance, various concepts in capital allowance. We have also discussed loss relief. We also discussed basis period. So these are very, very important discussion that you have to have. We have to understand for you to be able to completely attempt questions on companies income tax. They are very important. Now, when I was taking my physical class last week, one of the things I told them was the fact that if you are interested in understanding the hydrocarbon tax very well, you must also have an understanding of companies income tax. It is very important and essential because company income tax is a subset that we're going to be discussing under hydrocarbon tax. And I expect every one of us in this class today to have also learned the company's income tax that we taught over about 3 or 4 classes. That was what we used in doing the company's income tax. So if you are with me, then we can also move on to the next topic that I want to talk about today. Okay, let's go on. So, as I was saying, in 2021, the government of Nigeria deemed it fit to sign into law what we've been carrying over for years. We say Petroleum Industry Bill. Petroleum Industry Bill has been a bill that government has been looking at to see the implication of that on the economy. So the government, for example, was unable to sign this law into into act for years. And in 2021, a shift took place where the Petroleum Industry Bill was signed into law. Note, however, that Petroleum Profit Tax Law is still in existence. But for the purpose of our class here, we're not going to be teaching petroleum profit tax because I consider that as a waste of time because examiner does not test that again. Okay, so our focus will be hydrocarbon tax. That is our major focus. So as I was saying, I said the examiner now focused on testing on the hydrocarbon tax. Maybe when the new syllabus comes out, maybe they would relegate Petroleum Profit Tax Act to skills level and leave this one at this level because you are expected to know the truth, because there are some companies that are still operating under the Petroleum Profit Tax Act. There are some companies still operating under the Petroleum Profit Tax Act. Now, what is the objective of Petroleum Industry Act? Number one is to promote exploration and exploitation of petroleum products for the benefit of Nigerians. For the benefit of Nigerians. Excuse me. For the benefit of Nigerians. Number two is to promote efficient and effective and sustainable development of the petroleum industry. Number three, we'll talk about to promote the safe and efficient operation of transportation and distribution infrastructure of petroleum industry, to provide or to promote, again, transparency and accountability in that industry. Even though we know what we witness now in Nigeria, we have not really been able to be accountable for what is going on in the industry. The industry is one of the toughest industries to run in Nigeria because a lot of secrets are there. We also talk about to promote the liberation of the downstream industry. Now, you know, for example, that a refinery operation is a downstream operation. And one of the intention of the act is to liberate that industry. Of course, that would have been made possible if what the Petroleum Industry Act says about NNPC being a commercialized entity is also taken effective. But unfortunately, NNPC is still being run like as if it's managed by government. And that is why we are having problem that we are having up to today. Because NNPC is still holding the downstream sector, is holding them down. And unfortunately, what we expect to get in that industry, we are not getting it. And that is why we are also having problem up to today, because most of the objective of the act is not really being effectively utilized. We also talk about to promote a conducive business environment for operation in the petroleum industry, which of course is not what we are seeing as of today. But even at that, we know that where we are supposed to be today is not where we are, but we know God will help us in this one. But we shouldn't hand over everything to God. Everything has to be, we have to follow the laid down procedures to be able to achieve our expected goal in the country. Having said this, we move on to the next thing. Now, one of the things that the Act was able to do was to distinguish between the authorities that will take charge of all these sectors. We have the upstream sector, we have the downstream and the midstream. Midstream is full of gas, is a gas sector, okay? And downstream is the distribution of petroleum products and, let's say, finished products. And the upstream is more of exploration and production of goods, petroleum products. Now, for the purpose of this, the administration of the upstream is carried out by the commission. We are going to see the full meaning of the commission, that is NUPRC. Before now, This commission used to be DPR, Department of Petroleum Resources, but now it has moved to the commission. We call it NUPRC, Nigeria Upstream Petroleum Development Company. So we're going to be seeing that as we move ahead. So meanwhile, for both downstream and midstream, it is governed by the authority. You're going to see them as we move ahead. So let's quickly talk about the administration of the upstream petroleum industry operations. So the Act further makes relevant provision on the administration of upstream petroleum in Nigeria, which should be administered by the Commission. They had vests linked title to any data and interpretation relating to upstream operations in the government of the Federation of Nigeria, and they had vests the administration in the Upstream Petroleum Regulatory Commission, known as the Commission Nigerian Upstream Regulatory Commission, NUPRC. You understand? Nigerian Upstream Petroleum Regulatory Commission. They are the one in charge of the upstream business. They are the one in charge of the upstream business. Just like I told you before now, this used to be called DPR. But now, the name has now changed to Nigerian Upstream Petroleum Regulatory Commission. So they are the one in charge of that. Now, there are various licenses that the company could have, especially the ones in the upstream operation. Now, these licenses moves from one stage to the other. The first one is the government gives you an opportunity to explore, to see what you have in the reserve and see if you want to move it to the next stage. Okay, so at that stage, we call it the Petroleum Exploration License. You're given that license. This license gives you the right of exploration, just to explore. That is what the right gives you. It doesn't give you any further rights than exploring. Excuse me. Okay, so the next one is the petroleum prospecting license. This license gives you the exploration rights, exclusive right to drill, exploration, and appraisal well, and also do some testing. And after that, you can do the testing for a maximum of 6 years for shallow waters and a deep offshore for 10 years. Now, what do we call onshore? Onshore is on the floor. Offshore, deep water, inside water. Do you understand me? So if it is onshore, you have a maximum of 6 years to explore. Okay? You are just carrying out testing, checking, you get, it does not really belong to you yet. So meanwhile, the next one is the mining license. This gives you all right to win, to dispose the crude oil, natural gas on an exclusive basis for a period of 20 years. After that, you have to take a renewal of license again. Now, responsibility to assign license is a commission that will do that to award license. Now, the commission is responsible for granting petroleum exploration license. So I remember there was one of these bid round that was involved. So it was NUPRC that wants to give that license, exploration license to people. So they asked people to what's it called, to apply. So that is one of their core mandates, to ensure that they provide the exploration license. So meanwhile, during this period, everything that the licensee sees belongs to the commission, like all the data that you have there, every information will be commission's own. The minister is responsible for granting petroleum prospecting license, okay? So it's the minister that is responsible for that, and so on and so forth. So we also talk about books of account and reporting by licensee or lessee, and so on and so forth. So I don't think I want to bother myself so much on all these notes. It's just for information's sake. But another area that I want to point your attention to in this my notes is the host community development. There was a particular section in the Act that spoke extensively about this host community, development. I spoke extensively about it, which is, I think, part 3 of the Petroleum Profit Tax Act. Now, this area, I want to focus on this area, because if examiner is going to talk about some theory, I think examiner might want to come from here. What is the function of host community development? So before now, we used to have what we call public relations and community development. Now, it was not structured before. And in such instance, the oil company, all they just do is to be socially responsible to the community where they operate. Is to be socially responsible to the community where they operate. But recently, when the act was enacted, the community development scheme was introduced. That is the host community development scheme. Now they now call it Petroleum Host Community Development. Now, what is this supposed to do? Is to provide this assistance to the community where you are deriving petroleum resources. So there's a community where the community that is hosting your assets, you are expected to advance their life. You are expected to ensure that that community does not suffer. Let me put it that way. You are expected to provide some basic amenities for them. Okay, that is the expectation of the act. And in doing this, the government established what we call host community trust fund. We're going to talk about that. Now, but what is the objective of this host community petroleum host community development? Petroleum host development communities. What does it mean? What are the objectives that we need to talk about now? We're talking about to foster sustainable prosperity within communities that you operate. Prosperity, share the resources within a community that you operate. Now, this is different from NDDC. This is different from NDDC, even though I want to believe that NDDC and NDDC should have addressed the issue of this one, because oil companies pays NDDC levy, which is 3% of their budget every year. 3% of their budget. So if you had budgeted $100 million, 3% of $100 million goes to NDDC, that is to develop the Niger Delta region. You can see how wasteful the Niger Delta has become. In the recent time when they were probing people in Niger Delta, you remember the professor that fainted. You remember the incident of Off Your Mic. Imagine the number of oil companies that we have in Nigeria that are paying into this Niger Delta. I don't expect that the environment, up till we speak, will not be one of the best in the country. I mean the Niger Delta Commission, the region. Because that Niger Delta region, that commission has a whole lot of money they can use in developing that region. But what do we have today? What we have today is corruption here and there. If this Niger Delta Commission has been doing their bit, if they have been doing their work, there might not necessarily be another body like this that the government will have to create to ease the problem that they usually face. Imagine another Delta Commission has done what they're supposed to do, there will be this problem. But unfortunately, the problem will continue to persist if we have not nipped in the bud the corruption in the oil sector. Everybody wants to steal money from one person to the other. They want to steal money. And government too is also lackadaisical about this, because the government officials are the one aiding and abetting these people. Because I do not see any reason for introducing this, but they have to introduce it so that the asset of the oil companies in that community can be secured. The Niger Delta Commission that you have provided 3% of your budget to every year has refused to live up to their responsibility. I have refused to clean up the mess that these companies are doing. Then there's a problem. So to solve this problem is for the government to quickly establish a structure that will cater for the need of the immediate people that are directly affected by the oil company. Okay, so that is that. So to foster prosperity, to also provide direct, you can see the word direct, social and economic benefit from petroleum operation to the host community. Host community. Again, for peace to reign between the oil company and the host community, because they know that if they are going to stay in that economy, or sorry, in that environment, they must also take care of the people. They must take care of the people. Therefore, for peace to reign, that is why one of the reasons why it was established. Do you have any question at this point? I know there won't be any questions, just explanatory notes. Okay. Now, we now have establishment of host community development trust fund, where the commission or authority shall make regulation on the guidelines, how the fund should be utilized, and the commission shall also have oversight on this community. Now, one of the things that the oil company is expected to do is to incorporate a host community development trust within 12 months. The trust shall be incorporated within 12 months from the effective date for existing mining lease. That is, the company that has been operating before now, within 12 months in that community, you have to establish that. The trust shall be incorporated within 12 months from effective date for existing designated facility. All those English is still the one that has been existing. Now, anyone that has not existed, that just want to start, they must also put this into consideration. How would this company, as in this host community, be funded? The host community shall be funded by 3% of your operating cost. So the holder of the license shall pay into the endowment fund to be created for the trust on annual contribution of an amount equal to 3% of the operating cost of the operator in the previous year. So if you have expenses of the previous, because you might not necessarily be able to identify the expenses for this year, okay? But expenses for prior year that has been audited, you already identified that. So we are saying we are giving 3% of that to the host community. The community that is hosting you, 3% of that to them. The asset also provide that where a settlor or an operator transfer or assign their interest in a license or lease to another party, obligation to pay an amount in this endowment shall be transferred to the transferee. Okay, so the person, if you have transferred it, then the person that you have transferred it to will pay this thing. So the act also provides that where a license is revoked, terminated, or expired under the act, the holder is obligated to continue to discharge its surviving obligation under the act. I don't think this makes sense, but that is what the act says. You have terminated my license, and you are still telling me that alaye, you will continue to pay. No, you have terminated my license. You have revoked it, except if I have the inkling that I'm going to get what was it called? Get it back. Then I shall do that. Then I can do that. The next one. Now, this fund that I want to give to you as a company, that fund could be taken back. The host community can forfeit it if there is no peace, civil unrest, you are sabotaging our assets, you are damaging our assets, act of vandalism, sabotage, or civil unrest that cause damage to the petroleum facilities, then we are not going to give you the amounts that we have committed, because you have now disrupted our activity, or you have disrupted our activity. Number one is, we said, vandalism. Two, civil unrest. Three, disruption to production activities. Now, if this occur, then we will not give you the amount that we have promised to give to the host community again, because you have disrupted our activity, you have caused civil unrest, you have sabotaged our assets, you have destroyed our assets. Then that amount for that year, the host community will lose it. So indirectly, you are tying their hand to the extent that they will not be able to damage your assets because of this. Tying their hand. Like, if you go ahead and destroy my assets, this value I have promised you. Imagine when we are talking about oil company, 3% of their operating costs. No be small money. I am telling you what I know. No be small money. Even marginal field company, a company that has very few assets, they are making billions of naira every year, and they are incurring billions of naira every year. Imagine if you have you incur 5 billion as expenses, operating expenses. 3% of 5 billion, that's about 150 million. Abi, not be small money. Not to now talk about companies that are in upstream business, big operators, like the likes of Shell, the likes of Mobil, the likes of Total. Their operating costs runs into billions of naira. I'm not even over 100 billion, because they report in USD. Okay, so if you get 3% of like 50 billion, that's 1.5 billion. Abi, 1.5 billion is not a small money. So you will do everything within your means to ensure that you maintain peace, so that that money can come to you. If you spoil our assets, that money will come to you. So you read all this on your own. So what is most important to me is the fiscal aspects. This is very important, because as of this class, you are expected to focus more on the fiscal aspects, that is the tax aspects. Now, what is the key objective of the fiscal aspects? The key objective of the fiscal aspect of the Act is to encourage investments in petroleum industry while optimizing the revenue accruing to the government. Under the Petroleum Industry Act, the petroleum profit tax will be replaced with companies' income tax and hydrocarbon tax. Now, like I said the other time, the Petroleum Profit Tax Act is not completely out of place. A lot of companies are very intelligent and wise. What they do is that they check the economics. If the old one will pay them, they will continue with the old acts. If the new one pays, they continue. But the act deliberately says that companies are expected to move to the new tax act. The companies are expected to what? To move to the new tax act. But there are some companies that are still operating in the old tax act, that is using petroleum profit tax, because the act gave them 18 months from the date of incorporation, from the date of enacting this act, or the company that are still operating the that still has old license will continue using their old license. So, and in the old license, we have what we call operating mining lease. The mining lease, some companies just signed their mining lease under the old acts, and the mining lease will take the company for a period of 20 years. Now, company that is operating under that act can actually continue to use the what the 20 years period as stated in the act. Excuse me. Okay. Sorry, that's cool. That's cool. So, as I was saying, Sorry, guys. I have to quickly attend to something. Okay. So as I was saying, so the fiscal aspect is what we're going to be looking at. So objective is to establish progressive framework, fiscal framework to encourage investments in Nigerian industry, provide core principle of clarity, dynamism, and fiscal rule, expand revenue base of federal governments. That's one of the reasons. Revenue is the purpose of tax. Most governments want to ensure that their revenue base is not impacted by any provisions. Now, let's quickly go ahead. Now, what are the types of money collected from petroleum industry? Now, all money collected from petroleum industry that are due to government shall be transferred to the federal account, federation accounts in timely manner. These payments include, we have them, they are due to federal government. Taxes, royalty, production share, profit share, signature bonus, and so on and so forth. Now, responsible authority for tax collection and other revenue. Federal Inland Revenue Service is responsible for the collection of companies income tax, hydrocarbon tax, and tertiary education tax. Meanwhile, every other income, it is the commission that is charged with the responsibility of collecting that. Okay, so
Sir,
that is that.
sorry, sir, please, could you go over that again? The responsibility of FIRS.
Is to
Please, sir.
collect company income tax, hydrocarbon tax, and tertiary education tax. Responsibility of the commission. Every other tax, every other payment, apart from this, is the commission that is UPRC that will collect it. Okay. Now, what is petroleum operation? That is where we are now. Now, I'm going to give you a small definition that I believe encompasses everything that you need to know in petroleum operation. Petroleum operation is the same thing as the upstream operation. Okay? So, and that's why you see upstream petroleum operation here. When you talk about that, what petroleum operation is we talk about the exploration, we talk about the exploitation, we talk about the drilling of appraisal wells, we talk about the development of wells and other facilities, and we also talk about production of crude oil. I'll say that again. We talk of exploration, exploitation, drilling of appraisal wells, development of the appraisal well, that is laying of pipes and pipelines and everything, and as well as petroleum production. Now, that is what we do under petroleum operation. Now, there is one that is exempted from this. That is marketing and distribution of refined products. that will be under company's income tax, and that is downstream. So a downstream operation is the operation that has to do with marketing and distribution of petroleum products. Stop. That's downstream operation. Meanwhile, upstream operation encompasses the process of exploiting, development of well, drilling of exploration and appraisal well, and production of the crude oil. That is the simple explanation I can give you under petroleum operations. Now, for the purpose of this, for petroleum operation, that is the upstream operation, two types of tax will be computed. Two types of tax will be computed, which is the hydrocarbon tax and the company's income tax. This is what I explained at that time. All these are upstream operations. So I said we have two types of tax that we're going to be looking at. We have the upstream tax and we have the hydrocarbon tax and the company's income tax. So these are the two types of tax that the company is expected to pay, depending on the nature of the company. What do I mean? Depending on whether the company is an upstream company, whether it's an hydrocarbon, is an onshore company that is their production is on the floor, on the ground, or deep water, or marginal field, depending on that. Before now, under the Petroleum Profit Tax Act, company will only pay petroleum profit tax, which is 85% of their profit. Which is 85% of their profit. That is what they usually pay. Before now. That's what they usually pay before now. But with the advent of Petroleum Industry Act, that rate has crashed down depending on the type of activities that the company is into. Just like I've explained. Now, as I've explained the other time, I said this act introduced a dual tax regime where you would have the hydrocarbon tax and company income tax. Hydrocarbon tax is generally applicable to crude oil profits and profit derived from condensate and liquid natural gas liquid obtained from associated gas. What is associated gas? What is associated gas? An associated gas is a gas that is involuntarily produced. I'll take your mind back to your costing. When you were doing costing in the previous degree that you have done before now, you know we have what we call process costing. When you were doing process costing, you were taught normal loss. Normal loss will arise as a you are taught in foundation. Okay.
It's
foundation. So normal loss will arise. Okay, foundation, thank you. So your normal loss will arise as a result of the fact that during the production process, you are not intending to produce to have loss. But there is no way you will produce a finished product without you having loss. Take, for example, you want to produce furniture. You know, you'd have gotten, what was it called now? You would have gotten wood, right? In the process of getting the shape that you want, you will continue to file the wood. Even though that is not what you intend to do, you know, some people make use of that sawdust that comes out of the wood. I remember during Abacha regime, when kerosene was very expensive, virtually every one of us moved to sawdust. Sawdust is an example of normal loss. The person producing that sawdust did not want, it's not as if he wanted to produce the sawdust. That was not the intention. The intention is to make sure that the wood that is going to use is well filed. But during the process of filing down those woods, sawdust will come out of it. Sawdust will arise. So sawdust will be regarded as normal loss. It is not the intention of the person that is producing the crude oil to produce associated gas. In the process of producing crude oil, gas also comes up. So we say associated gas is a gas that is produced when crude oil is also being produced. Okay, it's produced alongside as crude oil is produced, it is also was being produced. So it is not as if the intention of the oil companies to produce gas, but there is no way you want to extract oil that gas pressure will not come out of it. So that gas is what we are talking about here. Now, what are the types of gas or what are the types of income that will not be subject to tax in hydrocarbon tax? Number one, we said associated natural gas. Now, the one we are talking about here is gaseous natural gas liquid produced in the field and contained in rich gas and non-associated gas. When you talk about non-associated gas, the company deliberately go ahead to produce the gas. Okay? The company what? Produce that gas naturally. So that kind of gas will not be subject to hydrocarbon tax. Rather, it will be subjected to company's income tax. The next one, condensate and natural gas produced from non is not subjected to hydrocarbon tax. However, it is subject to company's income tax. Do you understand? Non-associated gas is not subject to tax under hydrocarbon. However, it is subject to tax under what's it called? Company's income tax. Okay. We are also saying that condensates and natural gas produced from non-associated gas, condensates. You know, when you are cooking, let me use that as an example. When you are cooking, on top of your pot, when you open the pot, you will see some vapor. You know, vapor will now form some liquid. Do you understand me? That vapor that forms liquid is what we call condensate. Okay? Now, if that condensate is produced from non-associated gas or commingled with oil, it is not allowed to be taxed, it is not going to be taxable under hydrocarbon tax. Rather, it is going to be taxable under what? Company's income tax. Okay. The next one, any condensate and natural gas from associated gas as processing, as gas processing or are downstream. So we are saying any ordinary condensate and natural gas liquid produced from associated gas is subject to tax under hydrocarbon tax. However, if it is not from upstream, it is going to be subject to tax under company income tax. So by implication, a company could be operating both upstream and downstream. So we are saying that if that is the case, it goes towards only company income tax. It doesn't form the hydrocarbon tax portion. We are going to see it when we get to computation. The next one, important notes. CIT is applicable to all profits, whether it is hydrocarbon tax or not. You are going to subject all profits to CIT. By implication, only income that will be subject to tax under hydrocarbon will be sales of crude oil sales, that is profit of crude oil sales, sales of associated gas, okay, and sales of condensates, crude and condensates. The one that will not be subject to tax under hydrocarbon tax will be non-associated gas, condensates also from non-associated gas, and number 3, associated gas from downstream will not be subject to tax under hydrocarbon tax. Again, another thing that will not be subject to tax under hydrocarbon tax is other income. Let us assume that the company has other income. Other income is not subject to tax under hydrocarbon tax. Rather, it is subject to tax under company's income tax. I hope you are jotting. Anyway, there will be video, so you watch the video later. So, other income is not going to be subject to tax under hydrocarbon tax. Rather, it is going to be subject to tax under what? Under company's income tax. So, and by implication, I now come here and I told you that income, all the profit of the company shall be subject to tax under what? Under company's income tax. All profits, whether they are subject to tax under hydrocarbon tax or not, they are going to be subject to tax under company's income tax. Having said that, we move on to the next one. Now, you remember we said the cost of production of associated gas in upstream shall be deducted or allocated to crude oil for the purpose of computing hydrocarbon tax. Now, where a company produce associated gas or incur any cost in relation to the fact that it is for the purpose of producing associated gas. You know, ordinarily we said associated gas comes as a result of crude oil production. We are now saying that if, for example, this company deliberately intend to produce associated gas, then any cost incurred will not be what? Subject to tax under what? Hydrocarbon tax. Rather, it will be subject to tax under what? Company's income tax. Do you understand what I'm saying? So if a company that
Please.
this company is supposed to be producing crude oil, but in the of production of the crude oil, associated gas comes on, no problem. Any cost you incur in that will be allowable under hydrocarbon tax. Okay. We are now saying that if the company solely produced associated gas is not subject to tax under hydrocarbon tax. It is subject to tax under what? Company income tax, because the sole aim of your company now is to produce associated gas rather. If the sole aim is not to produce associated gas and the associated gas comes as a result of the what? Of the production of crude oil, that is subject to tax under hydrocarbon tax. But if the sole aim of the company is to produce associated gas, then any cost incurred will not be subject to tax under hydrocarbon tax. The revenue from such too will not be subject to tax under hydrocarbon tax. However, the revenue will be subject to tax under company income tax. That is that. So let's go. Hydrocarbon tax computation. Hydrocarbon tax computation. Hydrocarbon tax computation. Hydrocarbon tax shall only be applicable to production involving, I told you the other time, crude, condensate, and natural gas looking from what? Associated gas. Thus, the rate that will be applicable if the company is still mining and prospecting across onshore water terrain will be 30% and 15% respectively. So, if the company is in production mining lease, the rate will be 30%. If the company is in, what's it called, prospecting license stage, the rate will be 15%. And this is it here. This is summary. So converted or renew onshore or shallow waters, 30%. Whether the company is in development or commercial production stage. So 30%. The next one. The next one is if the company is on onshore or shallow waters and their mining license is still, if the license they have is PPL, okay? If the field is marginal field, let me put it that way. If it is marginal field, okay, then their rates will be 15%. If it is marginal field, if they are still in production, prospecting, petroleum prospecting license, they charge, the tax rate will be 15%. Any question? So that is that. It should be known that hydrocarbon tax will not be applicable to company with investment in deep English. Okay, let's go. How do you determine the crude oil? How do you determine the crude oil revenue? Crude oil revenue, how do you determine that? So we say it is going to be proceeds of all chargeable oil sold by the company and value of the oil produced by the company. It's the same English as far as I'm concerned. Now, general notes. Where the crude oil revenue of the company is less than the products of fiscal oil price as advised by the upstream company, upstream commission, then the excess shall of the crude oil sold shall be added back as revenue and so tax. This is what we are saying. A company has been using their own price to sell crude oil. Use your price to sell crude oil. And the NUPLC price is different from the price that you are using. What the act says is that the difference between the two will constitute income and will be subjected to tax. The difference between the two will constitute income and shall be what? Subjected to tax. Do you understand what I'm saying? So imagine an oil company sold their crude oil for, let's say, $30 per barrel. Okay? And they declare that as their revenue. Meanwhile, the price advised by NUPLC is $40 per barrel. You know, they have sold their own at 35. NUPLC says sell at 40. But because at times, you know, all these oil companies too, they are trying to see how they can push their products out, especially the one that does not have access to international markets directly. The company can decide to, well, sell at a discounted price so that at least the crude oil will go. So any price you now say, no, that difference, that is $5 times the barrel that we have sold will be subject to tax. It's going to constitute income in your hand, and that will be subject to further tax. Do you understand me? Don't worry, we have an illustration that
Sorry, sir.
that
What if,
that
excuse me, sir.
right.
What if it's
Go ahead.
sold higher? Hello, sir.
Go ahead. Oh.
Okay, okay. What if it's sold higher than what the NU PLC says? If they sell theirs as at 45, but or 38 per barrel, and the body is saying 35.
They have made profits now.
So it will still be subject to tax. No, still.
The difference will be subject to tax.
Okay.
No, so they are sold higher. That's not a problem for government because government will always take higher revenue. They want to maximize returns. So government will always take the higher one. Do you understand me? That is what government will take. Do you understand?
Yes, sir, I do. Thank you, sir.
Okay,
Sorry, sir, I have a question, sir.
right.
Yes, I'm trying to reconcile the first statement with the last one. You know, the first one, and like you explained, if the company is selling below the price, the fiscal price advised by the regulatory authority. But this last statement now is saying that the excess of the crude oil volume. So does it mean that if they did not sell beyond the volume, this place is talking about the volume, but your explanation is saying that the price at which they sell, does that mean that, okay, everything they sold, even if not, if they did not sell excess, the quantity they sell is within the quantity advised? Hello, sir.
So, yes, I understand what you're saying. So, number one, I am talking of the price. Is the price that we are talking about. So, where the crude oil revenue of the company is less than the product of the fiscal price. So that is, these products they are talking about here is the multiplication by the volume. Are you getting me? As advised by NUPLC. Then the excess crude oil volume sold or disposed, that is what the act is trying to do is to denominate what you have said you sold. So, for example, you have sold it at 30,000. What's it called? $30. Let's say you have 30. What's it called? You have 30,000 barrels, and you have sold it for $30. That means, when you look at that, you sold it for $30. How much would you have sold it? You would have sold it for, that is 90 million thereabouts. But you are supposed to have sold it more than that. So I'll now take that my volume again and multiply it by what you are supposed to have sold. So the excess, that is in terms of the income, I am subjecting it back to tax. Not necessarily the volume here. Now we are talking of the price. You have sold it lesser than what we are supposed to have sold it. Then I'll take the difference and I'll subject the difference to tax. Do you understand me? So that is that. So I have explained the other time that any other income will not be subject to tax under hydrocarbon tax, rather under company income tax. So let's go. The next one shall be, what is the basis for computing our assessable profits or our tax liability for downstream and upstream? For upstream, it is actual year basis. It is actual year basis. Okay? What is an actual year basis? An actual year basis period is a basis period that must have started and ended within the tax year. An actual year basis is a period that must have started and ended within the tax year. That is an actual year basis. That means what we are trying to say here is that your basis period must have started and ended within the tax year. So that's that. So it must be within the tax year. Meanwhile, for midstream and downstream is on preceding year basis. Now, according to PIA, what is accounting period? According to PIA, what is accounting period? Now, we're going to be looking at accounting period in 3 dimensions. The first one is when the company commence production of bulk delivery or disposal of crude oil. Number two, when a company ceases operation. And number three, a company that has been existing before now, that is going concern company. Now let's go. For an existing company, an accounting period shall be a period from 1st of January to December of that year. Do you understand me? For an accounting what? For an existing company, the companies must be a company that runs from January to December. That is their basis period or the accounting period. Now, for a company that is just commencing operation, any period, any shorter period commencing on the day the company first made the bulk or sales of chargeable oil shall be the what? The date of commencement. That is, from the day you make disposal of chargeable oil shall be your date of commencement. To the end of the year will be the, so that means from the date of commencement to 31st December of that year is the accounting period for a company that is just commencing. Meanwhile, for a company that is season operation will be from January to the end of the business life. Okay, adjusted profit. Now, the same concept that you know when you are discussing your adjusted profit is still the same concept that we are going to be talking about here. Now, in talking about adjusted profit, an adjusted profit is a profit that is only reasonable. Sorry, before you can say a profit is adjusted, you know, you must have adjusted for your taxable income, non-taxable income, allowable expenses, and non-allowable expenses, right? So we are saying in that regard, that must be taken into consideration. And before you say expenses are liable too, that all our expenses must be wholly exclusive, reasonable, and necessary for the purpose of generating taxable income. Right? So that is that. Now we're going to be looking at allowable expenses, and that's what we'll stop today. And I want you to take these allowable expenses seriously because they are specific and they are according to the tax law. They are all specific and they are according to the tax law. Let's go. Any amounts contributed and approved by commission for the purpose of decommissioning and abandonment are allowable. So decommissioning and abandonment, you can see that I highlighted it. It is allowable. Jot that down. Rents in pursuant to petroleum mining lease or petroleum prospecting license are also what? Allowable. Expenses incurred directly in repairs for repairs of plants, furniture, all those capital expenditure that you are repairs is allowable. The next one, this is very important. Any expenses incurred in acquisition of geographical, geological, and geochemical data and information is allowable. The next one, royalty incurred and paid within a period is allowable. Royalty incurred and paid within a period is allowable. Royalty is allowable. This point is very important. Tangible and intangible drilling costs incurred in connection with drilling of first appraisal well and first appraisal well, first exploration well rather, first exploration well, drilling of first exploration well, and first two appraisal well of the same field, whether they are productive or not, are allowable. We are saying first exploration well and first two appraisal well. Exploration well are not the same thing as appraisal well. If you look at what the examiner asked last diet, in the expenses, they put first exploration well and first two appraisal well. Those are allowable, okay? So it is allowable expenses. Now, any subsequent appraisal well shall be capitalized. Any subsequent one. That is, any subsequent exploration well after the first one shall be capitalized. Any subsequent appraisal well after the first two appraisal wells shall be capitalized. The next one. All sums, the liability of which was incurred by the company to federal government or any state government or local government council by way of levies, stamp, duties, and fee are allowable. Under company income tax, these are not allowable. Do you see? Under company tax, I would have told you any form of levy is not allowable. But here, it is allowable. The next one. Cost of gas reinjection wells, which are injecting natural gas that otherwise would have been flared. So what we are talking about here is that cost that you incur in reinjecting your gas into the well. Ordinarily, if you have not reinjected this, you would have flared it. And gas flaring is not allowed because it's havoc or dangerous to the environment. Therefore, any penalty you pay for government because you are flaring gas, it is not allowable. The next one, any amount contributed to any fund, scheme, or arrangement approved by commission, including host community development trust for Niger Delta Commission and environmental remediation fund, among others, are allowable. Do you understand me? Are allowable. So all these are the allowable expenses. So let's quickly talk about not allowable expense. What time is your next class?
10:30.
Okay, who is taking you that class?
Desalu.
Desalu audits, okay. Okay, so the next one is non-allowable expenses. Non-allowable expenses. What are non-allowable expenses? We know that these are expenses that are not only exclusively reasonable and necessary for the purpose of petroleum operations. Example of this is gas flare. Penalty you pay in respect of gas flare is not allowable. Disbursements or expenses not being money only, we have said that is not allowable. Head office costs incurred outside Nigeria is not allowable. Affiliate share costs, research and development costs, and any other indirect costs, production costs are not allowable. For petroleum company income tax, these are not, for hydrocarbon taxes are not allowable. However, research and development costs is allowable expenses under company income tax. Depreciation is not allowable. Now, this one, expenditure incurred to purchase information. Look at this. To what? Purchase information in relation to the deposit or other acquisition of geochemical, geophysical, and geological information and data are not allowable. This is not the same as this. Any cost you incur in acquiring it is allowable. But any cost you acquire in getting information about the petroleum deposits other than acquisition of geochemical. So we are saying that if you purchase information, it is not allowed. But when you acquire geochemical, geological information, they are allowed. But when it is you are purchasing information relating to petroleum deposits, it's not allowed. So we expect you to go and do all these things by yourself, rather than you purchasing the information. Capital expenditure is not allowed. Some recoverable under insurance contracts is not allowed. Capital withdrawn is not allowed. This one is also important. Interest on borrowing, financial and bank charges, arbitration and legal costs, and bad debts are not allowed. These are allowable under company's income tax, but they are not allowable under hydrocarbon tax. The next one, tax inputted. Any form of tax inputted in your contract is not allowed. The next one is tertiary education tax is not allowed. Meanwhile, and any other similar taxes is not allowed. Meanwhile, under company income tax, even though it's not allowed, but we charge it and pay to government. Rent or cost of repair, not for the purpose of petroleum operation, is not allowed. All custom duties are not allowed, and so on and so forth. We have so many that are not allowed. So that's why we stop the class today. When we meet in the next class, we'll be talking about accessible profit and loss relief and capital allowance. How is applicable under hydrocarbon tax? Good day to you. Do you have any question for me?
Yes, I have. All the time you were trying to clarify the fact that PPT has stopped for hydrocarbon tax and CIT. But you were saying that there could be, is it an exemption that if, for instance, a company just signed a contract, is it a contract now or just acquired an asset and is subjected to PPT just at the time the PIA came into force? Or I think the company will still have 20 years. Were you referring to the fact that they can still run with PPT for 20 years?
Yes.
I think it was
There
the
are some
second or
companies
third
that did
page.
not change. Yes, there are some companies that did not change to what's it called? To this act. They did not change. Do you understand what I'm
And the
saying?
law
They are
allows them
still using,
to stay put.
yes, yes, they are still using company income tax. Sorry, petroleum profit tax. And when you look at 2023 Finance Act, 2023 Finance Act is still adjusting some things under, what's it called? Under petroleum profit tax. There was still an adjustment under that petroleum profit tax. You get.
So if
So that's to
PPT
tell you
still,
that they
yeah,
are still, it's still in existence. That's what I'm saying.
that means we'll have to learn it then. We might be surprised with it.
I don't, I don't think there should be any surprise from ICANN on that aspect. Do you understand? There shouldn't be any surprise from that because it will be too much for you to combine hydrocarbon tax with petroleum profit tax. Okay, in the absence of no other question, we end the class for today.